Good morning. Why tenant mix determines value in commercial real estate. And in commercial real estate, value is not just about square footage or location or comps. It's about income durability. And income durability is driven by one critical factor, your tenant mix. So for retail centers or office buildings or even medical properties and industrial parks in Katy, Fulshire, and West Houston, the right tenant mix can increase your rents and improve financing terms and materially raise your property value. And conversely, the wrong mix can quietly erode both. So let's break it down. What is tenant mix? So, tenant mix just refers to the composition of businesses occupying a commercial property. So, you could look at that from a few different ways, like their industry type or the credit quality of the businesses or the lease length of each lease, but also their traffic generating capability. And a question to ask, is there any synergy between tenants? And in simple terms, who occupies the space and how well they complement one another? So, why tenant mix directly impacts your value? Well, commercial real estate is valued based on the income from the property. So, your value is going to be whatever your net operating income is divided by the cap rate for your given property type. And tenant mix is an influential item for both your value and your income. So tenant quality impacts risk. So a anchored by national brands or medical practices or even essential service providers will be viewed as a lower risk than a center filled with short-term unproven tenants. So think lower risk equals lower cap rate, which lower cap rate then equals higher property value. And lenders also reward stronger tenant profiles with higher leverage loans, but also better pricing and more flexible terms. Next point is that synergy drives revenue stability. And a well designed tenant mix creates cross traffic, is the concept. So let's give you an example. Say if we have a coffee shop that's next to a medical clinic, which is next to a fitness studio, but also there's a quick service restaurant like a Chick-fil-A, and each benefits from the other's foot traffic is the point. And when tenants feed each other with their demand, vacancy risk declines because what's good for the goose is good for the gander. And vacancy volatility is one of the biggest threats to NOI and therefore your value. So, next point is lease term structure matters. So, longer weighted average lease terms, or WALT, increases the predictability of the income. So, short term leases can create releasing risk, but also TI exposure for helping build out the space for a new tenant, and it disrupts your cash flow. Whereas a strategic tenant mix is going to balance some long term anchors with some medium term service users and select flexible tenants. And what this does is it creates a staggered rollover risk instead of a concentration of risk at one particular time. Four, next point, industry diversification reduces your exposure. So over concentration in one category creates a vulnerability for your project or your center. So let's look at an example. So if you have all fitness tenants, they're going to cannibalize each other. Or if it's all oil and gas office users, that could create a problem too. Or all boutique retail. And economic shifts can hit one sector disproportionately. So having a diversified tenant base is going to smooth your overall performance. And this is especially important in growth corridors like Katy and Fulshire, where rapid development can oversaturate categories very quickly. So let's look at tenant mix in your financing. And lenders do not price loans purely on loan to value. Some of the other things they're going to evaluate is, do we have any credit-worthy tenants, like national name brands with published credit, or if there's a certain industry exposure, or if the leases all roll over at the same time, or if there's a history of vacancy, or if there's a replacement risk with finding new tenants. And a property with unstable tenant mix could face lower loan proceeds, potentially higher debt yield requirements, but also potentially higher interest rates. And the point is, a 10% NOI disruption caused by a tenant failure can really materially reduce your loan size. So, tenant mix is a capital markets variable and not just a leasing decision. So, bear that in mind. So, let's look at some context for the Houston market. And in West Houston submarkets, medical office near expanding hospital systems typically perform differently than just speculative office builds. Or retail near master plan communities have demand service oriented tenants close to where they live. And industrial parks benefit from diversified logistics and service operators rather than through a single sector. And strategic tenant curation matters more today than ever. So, how do we improve the tenant mix? Well, if you're a commercial property owner, here's some few thoughts to consider. So, take a look at your rent roll and see, do an audit for industry concentration and see if you're over focused, or evaluate when your leases are rolling over, and hopefully you can stagger those. But you could identify cross traffic opportunities and reach out to your tenants to see if it can help them, but also upgrade weaker credit tenants during renewals and proactively recruit complementary businesses. And your tenant mix optimization is an asset management strategy and not a passive outcome. So, location is going to bring people in, and tenant mix keeps income stable. And then stable income determines your value. So, that's the line of logic for this. And if you want to maximize your commercial property value in Houston, start by evaluating who occupies your building and why. That, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk to you more about your situation. Have a good day.